makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the U.S. president has unveiled another round of tariff rates ranging from 20% on the Philippines to 50% on Brazil. Now, the latter is one of the highest rates announced so far. In his letter to Brazil, Donald Trump cited the treatment of the former president, Jair Bolsonaro, and called for charges against him over an alleged coup plot to be dropped. Now, let's get more on this from Bloomberg's EMEA news director, Ross Matheson. Ross, first of all, I mean, this is really, trying to confuse everything. It's basically, we're putting tariffs, but this is because the freedom of speech and against his former friend. So what's been the response from Brazil?
Well, that's right. As you say, this is actually Donald Trump using the threat of tariffs or imposing tariffs over a domestic judicial issue in Brazil because he objects to the treatment of his friend, the former president, Jair Bolsonaro, who's on trial, as you say, for allegedly trying to orchestrate a coup after his election loss. He's been complaining about the treatment of Bolsonaro for months. Now he's saying, I'm going to tariff Brazil because I don't like what you're doing to him. And it's also a representation of his relationship with the current leader, Lula. Of course, they've been butting heads, and Donald Trump has been threatening to put a 10% tariff on BRICS nations, of which Brazil is the B in that, and was hosting the BRICS leaders only last weekend for what he calls anti-American activities. And Lula clapped back at that publicly. So the two of them are butting heads. So this feels very political. It feels very personal. We had Lula coming out last night on social media saying, you're not going to force us to change course and certainly not going to force us to try and intervene in an independent judicial issue at home in Brazil. We're letting the courts do their thing. We're not going to try and influence that outcome or change it. And so he's very much digging in here on the Brazil side. Interestingly, Lula has been slipping a bit in the polls. He's been struggling. Obviously, Brazil, like other countries, has its economic challenges. And the question is, does this, in fact, help Lula at home to be engaging in this fight with Donald Trump? Yes, tariffs would hurt the Brazil economy. It's a big exporter to the US, a massive trading partner that does run that surplus, meantime, with the US in all of this. It would hit Brazil economically, but would it also, in a way, help rally support for Lula in the minute? So a lot of political strands going on there in all of this.
But, Ross, what kind of message does this really send to other countries? Again, 50% on Brazil for what's essentially a domestic issue.
Well, that's right. So we're seeing increasingly, again, Donald Trump blurring the lines. Trade is politics. Politics is trade, using tariffs, using sanctions very much as in a political way around the world. It's not entirely unprecedented. He did threaten, remember, tariffs against Colombia. There was a big dispute over migration. He then walked that back later on. So he changed his mind. He threatened those tariffs. And when he got what he wanted on migration, he did not go ahead with those tariffs. So it's not entirely unprecedented using this thing as really a weapon of politics around the world. But the message to other countries is, even if you've got a trade surplus, that doesn't mean you're in the clear. Even if you think you have a good relationship with the US, and particularly a good personal relationship with Donald Trump, that won't keep you in the clear. If there's something about your domestic politics that he doesn't like, if there's another political figure in your country that he is closer to and he wants to support, he may come in. But again, what we're seeing in this political climate now is just the use of tariffs and sanctions in all sorts of different ways, not purely for trade.
Ross, thank you so much. As ever, Bloomberg's EMEA news director, Ross Matheson. Now with us now, Grace Peters, co-head of global investment strategy at JPMorgan Private Bank. Grace, as always, thank you for joining us. I mean, look, it's a Trump show. It's a Trump trade show. It's difficult to actually see any other news that's moving any kind of market at the moment. What are you expecting in terms of tariffs overall? We don't really know where we end up.
We don't know, and I don't think that we can feign any false sense of precision, but I think that's exactly what the market's doing. It's saying, look, around mid-teens effective tariff rate is likely where we're going to land. With some of these letters, it looks more like 17, 18%. Sometimes it's more like 13, 14, but it's all in that range of a mid-teens level, which I think the major economies can stomach, and the markets can digest. We know it's a very well-versed narrative that will take about 1% of US GDP growth, add 50 basis points to 100 basis points, perhaps to inflation as a one-off impact that then fades. And that's why I think the market is looking through, some of this tariff tennis. Now, if we got to a stage where we moved out of that range, I think if we went to 20 to 25% effective tariff rates, I think that would prove more problematic. But we don't think that's the central case. We've been saying for a while mid-teens is about right. And that's why I think the market is taking this in its stride.
And Grace, I mean, again, it's very difficult to understand, some of the motives of the Trump administration. But is it mid-teens because they worry about a fallout from markets and bond markets especially? Is that the one that you're looking out for?
Yes, that seemed to be the one. If we think back to after Liberation Day, it was really the bond market, I think, that really caused the reaction and brought parties to the negotiating table. Volatility in equities, we always say, is normal. A 15% drawdown in equity markets is usually a good buying signal. And I think for equity markets, these are forward-looking discount machines. So, as I say, it's quite well versed to the notion that growth is going to slow, but it's also likely to recover in 2026. So I think the market is looking through, to next year's earnings, to next year's GDP that should be better than the current year.
Grace, the U.S. consumer has always been there. I mean, they've so far been fine. I don't know if there are jitters because of what's happening with, the Prime deals on Amazon or things like that makes you worry about, the consumer and the general U.S. economy.
Yes, I mean, the consumer is an area that we need to watch. Our own Chase card data has shown for some time that the consumer is slowing, and we've seen that from corporate earnings as well, and the consumer-driven sectors have underperformed in the market. So it'll certainly be something that we're looking at for earnings season. But let's also remember household wealth is at an all-time high. Household leverage is pretty low. The labour market is still incredibly robust. So consumers are financing spending out of earnings, their earnings. And so there's no reason to panic, to worry, we think. But it's just part of the natural slowing of the economy to slightly below trend levels over the next 12 months, we think, as I say, but with an upward tilt for next year.
And what does the Fed do in this case?
Yes, on hold, I think. I think so. The Fed next meet at the end of the month. I don't think the data that we're seeing at the moment means there's any need for them to consider any action then, probably not even in September. But I think as we get towards the back end of the year, those signs of cooling, in the economy will probably prompt another cut, perhaps another couple next year. But the economy is functioning at the moment, even though obviously I think cuts would be taken very well by the equity market.
Grace, how much volatility are you expecting overall? There's been actually arguably not as much as maybe we would have expected given the news flow.
Yes, well, we've just seen the VIX fall right back down again. Look, I think there is going to be more volatility going forwards, and included within the notion of volatility, more than just, sort of the VIX as a measure of that, is actually dispersion of outcomes. Mm-hmm. And so our core theme has been strengthening portfolio resilience this year as a way of, we still absolutely believe clients should get invested, they should stay invested, but in a risk-aware way. So it's focusing on the risk as well as the return. Mm-hmm. That does mean using assets that can actually benefit from volatility, like structured notes or hedge funds, but more broadly, it's preparing for a range of outcomes that includes adding infrastructure, gold, and inflation-correlated assets, or sources of income that can do well despite exactly where GDP lands.
Where do you see European markets and European companies? Because there's always, there has been this belief, especially with the spending coming from Germany, that actually this is the moment that Europe will do well. You look at NVIDIA, almost 4 trillion, and you kind of think, does Europe really have a chance?
Yes, I think it does have a chance. Now, it depends who you're comparing it against. I still think that AI is going to be the dominant story, so I don't know if it has a chance against, US large cap tech. But if we think about the other 493 companies in the US, I think Europe does have a chance against that group. I'm quite excited about Europe. I think that the estimates for what the infrastructure and the defence spending can do for GDP are generally quite conservative. People have used quite a low fiscal multiplier, particularly on that defence spending. But I think the exciting bit when it comes to the equity markets in Europe is firstly, as companies build conviction that order books are growing, security of earnings are growing, the aftermarket that will follow, so this is a multi-year story, I think that will be interesting. And I think there is a broader flows picture around how much people have built up overweights to US assets and the dollar, which will benefit Europe as well.
Okay, Grace, let's also talk a little bit about copper, because the US president has confirmed that a 50% tariff on copper imports will take effect from August the 1st. Now, Trump has pledged that America will build a dominant copper industry of its own. So let's get more from our Bloomberg metal and mining reporter, Mark Burton. Mark, so how are traders, first of all, reacting to this in the short term, and what kind of impact could it have in the longer term?
Morning. So in the short term, we are seeing the kind of the culmination of a trade that has really been gathering steam over the past 6 months, where traders are anticipating tariffs. They've been moving huge volumes of copper into the US to try to front load those tariffs coming into effect. We are seeing in these final stages some very kind of unexpected and unusual shipments where traders are trying to move cargoes to Hawaii or Puerto Rico, for instance, just to minimise the sailing time, given that we only have just over 20 days left before the tariffs come into effect. The longer-term consequence is one that people are now really kind of increasingly focused on, and kind of picking up on Grace Peters' comments a moment ago. People, I think, were expecting a lower tariff, something in that sort of 10 to 25% range, which certainly would have been uncomfortable and difficult for manufacturers to deal with. But 50% is certainly at the kind of scarier end of that tariff spectrum as far as the possible consequences for inflation are concerned. Copper tends to be viewed as a relatively kind of benign inflationary input, like certainly relative to kind of fuel or food prices, and certainly prices can be kind of passed through the manufacturing chain less painfully than they can be at the pump or on the plate, but 50% is a huge levy to impose on America's kind of industrial manufacturing base.
Yeah, it certainly is, and it's taken a lot of markets by surprise. Mark Burton, thank you so much, our metals and mining reporter. Grace, I mean, when you look at copper, we were expecting something maybe not quite so big, because it's also self-harm to the U.S. economy. So, again, do you have to take a bet on whether then Donald Trump backs down if it starts hurting, or is it, all guns ahead?
No, I mean, copper is one of these critical, metals at the moment that's intricately linked to the AI value chain and therefore highly in demand. And so I think when we think about the impact of this, it's an example of where the economy and the markets are quite different, because you can actually buy hedges against this through the UK market, which the UK economy is maybe not one that I would be supremely positive about, but one of the great attributes of the UK market is the mining sector. And so I think that you can, as you think about that resilient portfolio and how you want to hedge for some of these different outcomes, the UK mining sector is one of the ways that you can do that. Real assets, materials at large, because that also gives you some exposure to China. And if you were to see any cyclical rebound in the region there, and also to some of the, as I say, AI infrastructure and climate energy transitions as well.
Grace, is there a danger that actually we spend so much time talking about the tariffs from the Trump administration side that we lose sight of the bigger picture for what it actually means for some of the big BRICS country? I mean, I'm thinking China, really.
Yes. I think that there's still a degree of scepticism from investors around committing too much to China. I think what's quite clear is that they have made huge technological advancements, better, faster, AI development, which I think benefits everybody. It benefits many players as well. So, look, within emerging markets, we tend to say, look, there are some drivers at the moment that could absolutely help emerging markets. But we want to choose the emerging markets where the GDP growth correlates and the value of that correlates to the equity investor. And within that, actually, historically, that's not been China as much, but it has been other regions, some in LATAM, but most notably India. So that's sort of how we're thinking about the EM complex at the moment.
So interesting, Grace. Thank you so much for coming on today. Grace Peters, our co-head of Global Investment Strategy at JPMorgan Private Bank. Now, coming up, we'll discuss the outlook for global markets amid these rising trade tensions with Henry Fernandez. He's the chairman and chief executive of MSCI. That's next, and this is Bloomberg.
the corporate space, they would, my sense is that there is some absorption of the cost there. It'd be really interesting to see as we get through Q2 what earning results are like. So there's been some sense that there's some absorption of the cost, but there's also real efficiency gains. There was some pre-stocking coming up in March, and one or two have sort of said, well, we had a 4-5 month, maybe 3-4 month horizon in terms of where tariffs might settle down. Then we know what to do. We're in that zone now. We're sort of 3-4 months in.
Well, that was Bernie Mensah, president of International at Bank of America, on the impact of U.S. tariffs. Now, some of the world's biggest money managers, of course, wary of chasing the stock rally into the second half of the year. They're braced for more volatility and are concerned about tariffs, earnings, and U.S.-China tensions. Well, joining us to talk about all of this, Henry Fernandez, Chairman and Chief Executive of Markets Indices and Analytics provider MSCI. Henry, as always, thank you so much for joining us. I mean, there's a lot going on. Just keeping up with who's tariffed at what level and when the deadline is a full-time job. So where do you see the impact of tariffs on different markets?
Well, there'll be a lot of winners, a lot of losers, directly and indirectly. I always think that Europe should be a big winner. Maybe not immediately, not directly, but this change is definitely a little bit of a godsend or a disguised godsend for Europe, because it's going to shake it up and say it's time for you to release the cornering of the market for regulations and unleash that talent and that creativity, even though there will be obviously adjustments. I was just in Vietnam, and it's going to be hard, for Vietnam and Southeast Asia. Obviously, the ASEAN, group is convening now. I think, obviously, biggest countries that are going to get affected: Japan, UK, Germany, Canada. Yeah. My good friend Mark Carney.
But Henry, I mean, if you look at Vietnam, so do they have to choose between, the U.S. and China? So they have a double trouble.
I think they'll have to diversify. I don't see any other choice. They typically are not very friendly with the Chinese, because there's always a lot of border tension. Yeah. But in the end, it's economic survival. So they're going to try to sell a lot into the U.S. and try to sell a lot into China. The only thing is China is in a deflationary cycle, given all of the demographics and other things. And the question is how much China is going to push a consumer economy and a service economy. So everyone is talking about maybe, Europe and China is the places where to sell, but their own countries have their own protections.
But how do you see actually trade changing, right, because of tariffs? Because the million-dollar question is, if you have a fragmentation, is it away from the U.S. and is there a pool of countries that come together, or is it each for their own?
Well, there is an inexorable, incredibly forceful trend of globalization. That's not going to change. I mean, it's going to slow down in parts of the world and periods of time, and then it's going to come back in force. I don't think there is a big deglobalization going on. What I think there is a reglobalization. It's a shifting of all the demand-supply dynamics and the manufacturing centers and the supply centers and all of that. But what I always say to people is, people are focused on the merchandise trade. If you think about economies of the world, U.S., Germany, obviously UK, 80% of the economy is services. So the future of employment is not in agriculture. We know that. It's not in industrial. The future of employment is in services. So the U.S. has a huge trade deficit, $900 billion in merchandise trade, but it has a $300 billion surplus in services. What Bloomberg produces, information and media, data, and all of that is a digital good. That's an export. And that is part of that, trade surplus in the U.S.
But the U.S., or at least this administration, wants a different America, right? A different economic template for where they see the USA going.
So it will be. There will be. And part of it, you could say, is a real adjustment, because a country cannot live forever with a huge trade deficit, right? So part of that is an adjustment. And as the world adjusts, to 10% tariff or 20% tariff, generally, there will be effect. There will be a slowdown of the economy that was going to impact capital flows. It's going to impact financial markets and all of that. But in the end, I'm not a strong supporter of it, but in the end, it's probably going to be good for America, after the adjustment period.
So when you say, we're not in deglobalization, it's maybe a slowdown, and we're not into violent fragmentation. Are there going to be countries that will work together? Is China does it have a big role to play in this?
Yeah, I think the world has been an America-centric world.
Yeah.
And everyone looks at the U.S. as a market in terms of obviously buying treasuries or foreign policy and the like. And I think what this change is really creating a huge impetus for countries to bank together. The ASEAN countries say, we got to increase trade dramatically. The Prime Minister of Singapore was in Vietnam a few weeks after, April 2nd, in order to figure out, how are we going to work together. The European countries are doing that. Even the UK right now is saying, gee, our future maybe is with the European Union. It's not going to be an exclusionary process, not going to be at the exclusion of America. So I think that change is not bad. It's not bad for the world. There is more diversification, there is more economic growth, there is more production, all over the world. Now, there will be a period of adjustment, and that's not going to be good, right?
So there's massive trends in private credit, in private markets, but also AI. What do you think will be more disruptive?
AI, for sure. Because that's a long-term secular trend. Going back to employment.
Even in your world?
Oh, yeah, in our world. I mean, our world is made up of three ingredients: data, models, and technology. And those are the three places where AI is highly revolutionary and highly disruptive. So therefore, if you are not at the head of that, somebody else is going to disrupt you. So AI, for sure. And that's going to have a big effect on employment in the world, big business models, countries, competitive advantages, and all of that. But private credit, the new banks of the world are the credit funds, because the banks are being very heavily regulated. Credit extension is not as easy coming out of a bank. So we're going to see a rewriting of the finance industry in the world.
But are you worried about that, Henry? Because actually it's just, it's difficult to see at times what's in that, like the valuations, because there's so much debt is frankly much more murky than the private, the public markets.
We are worried about that, but we're also taking steps to create transparency. So we got about $2 trillion of databases worth of underlying credit in our funds, in our databases. It's not our funds, it's our clients' funds. So what we've done is we looked at that and partnered up with Moody's. We're taking Moody's probability of default models, apply it to our database to create credit scores for the underlying holdings and the funds, so that people can really have a good sense of what's the leverage and what's the credit worthiness of those funds. I think that is definitely very timely and overdue.
Henry, we only have time for a final quick question on ESG indices.
Yeah.
Is there still appetite for that, or
ESG,
are people backing away?
Sustainability, as we call it today, is here to stay, because it's part of capitalism.
No reversing.
No reversing. Now, there will be a slowdown. There is like a soccer game. The referee says stop the game in the UK and in the European Union, and in the US it's political, but it's going to come back. And that is the ESG part. And then the climate part is in a tier, because we see all the physical risk around the world.
Henry, as always, thank you so much for coming on. Henry Fernandez there, Chairman and Chief Executive of MSCI. A disclaimer, Bloomberg LP, the parent company of Bloomberg News, competes with MSCI by compiling indices and providing analytics for stocks, bonds, and commodities. We need to make that clear. Henry, thank you. Coming up, we'll discuss the outlook for luxury fashion and the impact of tariffs with Patrice Louvet, the Chief Executive of Ralph Lauren. He's coming up next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Donald Trump hits Brazil with a 50% tariff, citing a witch hunt trial against former President Jair Bolsonaro. Trump also confirms a 50% levy on copper imports will come into effect on August 1st as U.S. prices surge. Plus, a new milestone for NVIDIA, the poster child for the AI revolution, starts the $4 trillion club. Now, as nations rush to finalize trade agreements with President Trump, retailers or diversifying sourcing to cut costs. Now, luxury fashion brand Ralph Lauren expects its strong revenue growth to ease in the latter part of the year as uncertainty around the impact of tariffs weighs on consumers. The company has seen its shares rise around 25% this year, outperforming other brands. And I'm very pleased to be joined by Patrice Louvet, Ralph Lauren's chief executive. Patrice, we've made a little bit of an annual interview because you always come also for Wimbledon, which you sponsor. So congratulations on that, but you must be busy with tariffs.
Excited to be here.
Excited to be here, but you're also dealing with tariffs, which seem to be all over the place. So does it change actually your supply chain? Does it change how you see the world?
You know, this company has been around for 58 years, so we have gone through many different economic, geopolitical silos, phenomenons. Of course, tariffs is a factor right now for us. We're really focused on the consumer and making sure that we're delivering to the consumer amazing value and something that's engaging from an emotional standpoint. The situation on tariffs, as you know, continues to evolve. We've run a number of different scenarios. We have a proven toolkit of how to manage cost headwinds. We've had prior cost headwinds. If you think about the price of cotton, that increased dramatically as a result of COVID. So the combination of diversified sourcing, as you mentioned up front, the fact that we have strategic partnership with a number of our suppliers where we can really work efficiencies throughout the entire chain. And then a brand that's got strong pricing power so that if and when needed, we can take selective pricing and promotional activities. I think positions us well in this environment of uncertainty. Again, all of our energy is making sure we're getting the consumer excited about our storytelling, about our products, and providing great experiences around the world.
And Patrice, how is the consumer doing? So what are they looking for? Is it in terms of brand recognition? It's there. Do they want upper end? Is it middle end? Do you see a change in behavior at the margins?
So it's pretty clear that around the world, and I've been traveling a lot recently. I was in China just a few months ago and parts of Europe this week. There's a high level of uncertainty, and that's likely to continue. I think what we are seeing in general is consumers are looking for brands that are dependable, consistent, timeless. And when you look at our core consumers, which is a subgroup of the broader population, our core consumers are actually still very, very resilient. And that's true in Sydney, in Shanghai, in Milan, in London, in Los Angeles. And I think what the consumer is telling us is they really appreciate the values of authenticity, optimism, right? We need optimism at this time, timelessness, aspiration, that resonates with them. And from what we are seeing, our consumer continues to be strong around the world.
I mean, we went for their brands with many logos being very popular to quite luxury. You say timeless. Has it gone into a different direction where actually people want to hear stories, want to hear family stories? And has that changed? Or, I mean, you're also selling like Americana. What does that mean to you?
Yeah, I think it's very interesting. During times of uncertainty like the ones we're in right now, we do see consumers gravitate to brands that they know, products that they trust. They're more discerning with their dollars, right? The consumer is smart. They recognize quality when they see quality. And so what's very interesting when you look at the part of our lineup that is responding really nicely right now, it's our core products. It's our cable knit sweaters. It's our tweed jackets. It's our Oxford shirts. It's, of course, our polo shirts. It's our pony cap. So that's actually, the breadth of our lifestyle portfolio is actually serving us very well here. And the core that the consumer knows well from Ralph Lauren is really resonating. Again, what's exciting about the company performance right now is the breadth of performance wherever you look, by market, by channel, by consumer group.
Where do you see more opportunities? Is it in women's wear? Is it? I know you also are quite big in homeware.
Right.
Is it what's growing the most?
So what's exciting about this brand is it's a true lifestyle brand, right? We serve generations from newborns to 90-year-olds, and we sell a pack of tennis socks and $300,000 watches, and the entire range. Our challenge, actually, Francine, is making choices with all these opportunities. But if you kind of ask me, well, yeah, sometimes the hardest answer is no, not now. We'll do it later. Certainly, if you look at the macro numbers, the biggest opportunity for us is women's wear. So this company was built on menswear. That's the rock of the company, is the way I think about it. We have significant opportunity in women's wear around the world. We have a 3-brand portfolio, collection at the high end, Polo Women's and Lauren. We're seeing really nice momentum on that business. It's about a $2 billion business for us. The total addressable market, depending on how you do the math, is $150 to $200 billion. So significant runway. And our design teams are doing a really nice job with our marketing teams developing product and storytelling that connects particularly to that younger consumer. Nothing makes me happier than to see a young 18-year-old walk down the street with a polo bear sweater and a pony cap.
I mean, when you talk about storytelling, is that through social media? Is it people that come in store and actually want to know about the story, or is it other channels?
So it's evolved greatly, and you and I have had a chance to talk about it over time. But from a more traditional kind of fashion show, print magazine, activations to now a broad range of programs, sports, right? Obviously, Wimbledon, U.S. Open, Ryder Cup, Australian Open. We have great partnerships with Lando Norris, who just won the British Grand Prix, with Aaron Judge, who's doing an awesome job with the Yankees. So that's part of the activation, really focused on spectator style. Mm-hmm. Then we have a lot of activations in gaming, right? We do things with Fortnite. We have a number of different things going on right now in different platforms. Celebrities, right, who have an authentic relationship with us. And then there's the experience in-store and online. And what we are really focused on is to make sure we're creating this environment where you can step into your dream, right? This company is all about dreams, much more than it is about apparel. And how do we create these experiences that help people think about something different than dream?
Patrice, I remember, a couple of years, actually maybe 2 years ago, you telling me what's important about Wimbledon, because we're in full Wimbledon fever here in London, is that you turn the camera to look at the spectators, and you see that like every day you have images of celebrities showing that. Is there another sport, or is there another industry where you could do the same, where actually there's the fashion luxury world and this other industry become much more powerful combined?
Yes, and again, it's a question of choices for us. So we're in golf, right? We actually are the outfitter of the U.S. Ryder Cup team. Mm-hmm. We also have a number of golf players. We have opportunities that come across many different sports. We're looking at cricket as a potential opportunity. There's an important game happening today. So again, for us, the point is, where's our target consumer? Where do they want to engage with our brands? And how do we make sure we're there? Formula One, obviously, is an important area. That's why we're really excited to have this partnership with Lando Norris, who happens to be doing quite well this season.
But so how do you choose? And again, I mean, Formula One is seeing a massive revival thanks to Netflix.
That's right. We choose through being laser focused on the consumer we want to talk to, and understanding from him and from her where they want to engage, how they want to engage. And then we make sure that what we offer is unique and distinctive and authentic.
Patrice, how's the Asian consumer doing compared to the European?
So there's a lot of conversations around Chinese consumers being pressured, for example. And obviously we see that holistically, but our business continues to be quite strong across Asia. Mm-hmm. The standout is clearly China for us, 20% up last quarter, 20% up the quarter before that. I think our teams on the ground are doing a great job connecting with that consumer, that younger consumer, evolving the storytelling that's still very authentic to who we are, but really resonates with them culturally. But we're seeing that in Japan. Japan is quite strong for us right now. We're seeing that in Korea, also great performance there. We're seeing that in Australia. No, I'm really pleased to see the work the teams are doing around the world.
What's your biggest challenge? I don't know whether, there's currencies, there are things that are completely out of your control, like exchange rates. But do you worry about them? Do you hedge, or do you just, so, it is what it is?
As a philosophy, Francine, we really say let's focus on what we can control, right? Because we could spend a lot of time chasing things that are out of our control, and that's not good use of our resources and our energy. But the greatest concern, I think, for all business leaders right now is the uncertainty, right? And we like to have some visibility so we can plan accordingly, and obviously there's a great deal of uncertainty. When it comes to currencies, we guided in May that we expected currencies to be roughly even impact for the fiscal year. There's been some movement. We'll update the street when we announce our results in a couple of weeks. We do hedge. Mm-hmm. But at the same time, we're also clear on what we can and cannot control. And I think, as we've been talking, the focus for us is get the consumer excited about what we have to offer, get them engaged, and good things will happen as we do that.
Yeah, not even central banks can control currencies right now.
Let alone Ralph Lauren.
Thank you so much.
Thank you, Francine.
Louvet, they're the chief executive of Ralph Lauren. Now, another corporate news, Italy's Ferrero is said to be closing in on a deal to acquire Kellogg. Now, sources tell Bloomberg that the Nutella maker is looking to buy the breakfast cereal producer for about $3 billion. Talks are at an advanced stage, and a deal could be announced as early as this week. Now, senior officials from three of OPEC's core producers' nations, Saudi Arabia, United Arab Emirates and Kuwait, say that supersized addition to supply by the producer club was needed by the global market. Now, these comments made at the OPEC seminar in Vienna. Our Giuseppe Lavazza is there for us. Hi, Giuseppe.
Hi, Francine. Yeah, well, we're on day 2 of the OPEC seminar, and I would say the major takeaway is both short-term and long-term. The OPEC group of producers, alongside other ministers who are present, seem to be pretty positive and optimistic about the state of demand. And certainly OPEC Plus and that group of aides who decided to put those extra barrels back to the market sensed a window of opportunity to do so without causing a meaningful impact on the price of oil. And indeed, over the course of this week, you haven't seen that much of an impact despite the extra putback. So those are some of the discussions being had here. But I would say also more longer term, there's been a lot of talk about the importance of hydrocarbons in the future energy mix. Yesterday, ABS, the energy minister of Saudi Arabia, kicked off the conference talking about the importance of hydrocarbon solutions in long-term planning and that you have to be pragmatic about the transition. It cannot come at the expense of affordability and energy security. No surprise, really, that is a theme that's resonating amongst many of the people here at the seminar. And then in about an hour's time, we'll be getting also what's known as the World Oil Outlook, the WOO they call it, which is a long document talking about OPEC's long-term projections for how they see energy demand and also supply. So that's something to watch out for.
Yeah. So, Giuseppe, how do the conversations from the ground actually differ from what Wall Street analysts are predicting?
Yeah, so it's interesting. In the run-up to these big OPEC plus production hikes, many Wall Street analysts had been anticipating a supply glut to hit as soon as the third or fourth quarter of this year, and that the supply growth in the market would outpace demand growth. And actually what we've seen over the summer, demand has been pretty strong. The seasonals have been supportive. And this echoes some of the commentary that was put forth by these oil ministers. Yesterday, the UAE oil minister saying that the fact that inventories are still quite low, even though OPEC have put back these extra barrels, is indicative that the market can absorb it. So from here onwards, you want to keep a close eye on what happens to that global stock of inventories. That will move the needle, especially because in the U.S., stockpiles have started to tick back up again. The latest data is showing that that's starting to pick up. Will that balance change in the coming months, and will that start to exert downward pressure on prices from here? I think that is a big question. And many of the Wall Street analysts that we've spoken to, Goldman, Citi, RBC put out commentary yesterday as well, all suggesting that later on this year you will get an overhang of supply versus demand, and that should exert downward pressure on the price of oil. Most of them are targeting a price of low 60s, perhaps some in the case of high 50s by the end of this year, beginning of next year. So the dynamics most likely will change, but the narrative of Wall Street certainly appears to be slightly more bearish than some of the language that we're hearing from these OPEC ministers here.
Giuseppe, thank you so much. Giuseppe Lavazza there in Vienna. Now, also making news, Linda Yaccarino is stepping down as chief executive of Elon Musk's social media platform X. Now, the former NBC Universal executive was hired by Musk in 2023. She joined at a time when Musk had fired or lost about 75% of employees at the company previously called Twitter. Amazon's annual Prime Day sale is underway, but initial numbers from the 4-day shopping event are indicating weak sales. Momentum Commerce, which manages online sales for 50 brands, said its Amazon sales plunged 41% in first-day sales compared to last year. And Amazon is betting on the extended sale period to give shoppers more time to navigate the millions of deals on its site. Blackstone says it signed a private credit partnership with Legal & General that the two firms aim to grow up to $20 billion over the next 5 years. Now, it will see the U.S. alternative fund giant originate investment-grade private credit deals for the UK insurers' annuities business. Now, alternative asset managers and insurance industry tie-ups are seen as a key growth driver for the emerging private investment-grade market. We also have reports saying that the European Commission is finalizing infringement proceedings against Spain over the conditions it imposed on BBVA's offer for Sabadell. Now, the newspaper Expansión says the Commission believes that the terms set by the Spanish government last year are contrary to the free movement of capital. Now, coming up, we'll ask if coffee's rally has peaked. My interview with the Lavazza chairman is next. This is Bloomberg. Welcome back, everyone. Our favorite subject, coffee prices. So coffee prices have been falling after reaching record highs in February. Supply concerns earlier this year had sent prices soaring, forcing roasters to transfer costs to consumers. Now, the industry is also weighing the impact of tariffs, climate change, and, of course, planned European rules aimed at tackling deforestation. Well, I cannot be more pleased than to be joined by Giuseppe Lavazza, the chairman of the Italian roaster Lavazza. So thank you so much, Mr. Chairman, for joining us. I mean, first of all, look, the big story overnight, and we've had quite a lot of stories on tariffs, was basically the U.S. tariffs on Brazilian goods. That would be about 50%. What does that mean for coffee prices, but especially Arabica?
Yeah, Brazil is notably the most important coffee-producing country. So working in coffee, it's mandatory to have coffee coming from Brazil. It's part of the recipes, it's part of the coffee people enjoy every day in the world. And so having tariff for U.S. on Brazilian import coffee, of course, it means that the price of the coffee cup in Brazil has to rise quite a lot. 50% is really high tariff. So it could create a lot of inflation in our industry that's already under stress because the problem of green coffee beans that notably saw very, very much during the past 4 years.
But Giuseppe, I mean, Arabica prices are fluctuating sharply this morning. Again, is this an early, sign indicator? And if you look at the Brazilian Arabica market, can it be shipped to Italy? I mean, does it change supply chains, or is it something, or have agreements been signed like years and years ago?
No, there are not long-term agreements in this industry. So normally you can decide to buy coffee from different countries. So of course, if some tariff hits a specific country, roasters try to avoid to use a very expensive coffee. Maybe they try to ship to other coffee. But nevertheless, Brazil is so relevant in coffee industry. It counts for about 40% of the total production. And with Vietnam, they altogether counts about 55%. So not having Brazil coffee disposable means distortion in the market, restriction in the coffee availability, and so high tension on the prices of green coffee around the world.
What does it mean for Lavazza? And again, you could have this massive dislocation between future prices and also spot price.
But yeah, we try, of course, to manage quite carefully the prices of coffee. But for Europe, this is a different situation because we don't have this system of tariffs. So we can, for example, buy our coffee. We have other issues, of course, high coffee prices, U.S. regulation that acts more or less as tariff because it reduces the quantity of coffee we can buy from different countries. So it's a pretty tough environment, and I hope lawmakers have the sensitiveness to understand this.
But so it doesn't necessarily impact actually the, where you buy your sources. I mean, it doesn't necessarily impact your sourcing strategies, basically.
No, really not. Of course, we try to keep strictly under control the quality of our products. So despite high prices, despite this kind, for example, of difficult situation, dire straits, we keep pay a lot of attention to the quality of our recipe. Yeah. We don't accept any kind of compromise in terms of composition of our blend. This is part of the trust that we build with our customers and consumers around the world.
Do you think U.S. roasters need to start reformulating actually some of their sourcing? And so does that, again, is it a competitive advantage if tariffs aren't too hard on you coming from Europe?
Of course, the market move from one side to another one. If there are this kind of distortion in the market, we try to mitigate. But nevertheless, remember that for Lavazza, the taste of the products is very important. So we have some limits to do that. The most important things for us is to deliver to our consumer the highest possible experience in terms of coffee. So we can't modify, for example, the composition of our blends. We have some limits, and we can do, but with very, very short space. So more or less, the kind of coffee we have to buy every year is the same. If there are tariffs, of course, this means that the cost of coffee is higher. And so we have to deal with a situation of pressure again on cost, on supply chain, on negotiation with our customers. That's very, very dangerous situation, very tough.
But would you be able, given the consumer right now, would you be able to increase prices in certain markets?
We try, of course, to act very responsibly because, of course, we wanted to keep high our competitiveness, protect the customer, of course, and, of course, to try not to threat the trust relationship we have with the retailers, for example. But just to give you an idea, in 2019, the cost of coffee for Lavazza was about 6 million euros for 1 year. And nowadays, in 2024, is about 1.6 billion euros. So really a relevant shift. We can try to absorb some of cost in our balance sheet, but we also have the necessity to adjust the prices and so to have a price increase in certain geographies, in certain markets.
So a disclaimer, I love coffee and I have too many espressos probably. Where do you want to expand? I mean, you're known for the coffee, the espresso, the capsules in certain places. Is there an area that you're looking at? I was surprised to see, for example, Ferrero looking to buy Kellogg's. Is there something that you think that you want to get into which is away from coffee?
No, we are very focused on coffee. This is our mission since 1895. The company has a specific strategy to expand in interesting geographies, as notably North America, China, and even to try to cover all possible channels where people like to have coffee. Retail, away from home, e-commerce is growing quite a lot. And vending as well is another very interesting channel. So we try to expand in all these directions, but stay very, very stuck on coffee.
Very close to coffee.
Yeah.
This is probably very good news for coffee lovers. How do you see the China market actually evolving? I mean, it's a nation of tea drinkers, but you see actually pockets, especially in urban cities, where I guess gourmet coffee is really taking up.
And China is quite a very interesting potential country. Over the last 3 years, coffee consumption rose about 60%. It's a good sign. Chinese people love coffee, especially if it mixes with milk. They love a lot of recipes. And it's a high competitive market. A lot of coffee shops are active in China. We have a very interesting partnership with a Chinese partner, Yum China, with the aim of open around 1,000 coffee shops by 2028. We are about 100. We're testing our concept, but very confident that China will represent the future of the company in Asia.
But so what kind of growth are you looking at? Is it like 20% growth for coffee drinkers?
In China?
Yeah.
Oh, yeah. I think that China, the dimension of the business in China is huge. So if we consider that now is the first stage of the coffee in China, the potential of the market is exceptional. So think one Chinese can drink one coffee per day. It means that the world of green coffee has to double or to triple. So we need to have a lot of coffee production in the producing country to satisfy such a huge demand. So very good news for producers.
Giuseppe, thank you so much. Giuseppe Lavazza, the chairman of Lavazza. Now, we're also, of course, following the French president, Emmanuel Macron, here in the UK, in London, this morning being welcomed to Downing Street by the UK Prime Minister Keir Starmer. The UK and the French governments are planning to order more Storm Shadow cruise missiles, which they have been supplying to Ukraine. Now, Starmer and Macron are also expected to strengthen cooperation between the two countries on nuclear energy. And this is a reminder, the first state visit by a European leader to the UK since Brexit. Coming up, Bloomberg Brief, and this is Bloomberg.